All right, we should be on. Perfect. So, hi there. It's November the 28th, Saturday, 2020. We want to give our client monthly update, stock and real estate. So, my name is Christian Dye from Latitude West Financial, and I have our guests, Dara Fahy and Ryan Runte, here to give us an update as to what's going on in the real estate market. So, quick disclaimer, the information given today is not to promote the buying or not buying of any real estate or any stocks. This is for educational purposes only for our clients. So, Dara, we're going to jump right into it to see what's going on with mortgages, tail off of 2020 and what's going on into 2021. So, what's happening right now that you can see?
Yeah, good morning, Christian. Thanks for having me. We are seeing a ton of activity. There is a lot of buyers applying, a lot of refinance activity. And I would say it's a little bit different than in March. We're obviously in some harsh restrictions at the moment and whatever phase we're in with the pandemic. When we went through this in March, things really slowed down. And obviously the world stopped a little bit more than it has now. We have not batted an eye on the finance and mortgage side of things. It's been really steady stream of buyers applying every day. Definitely seeing, that's probably fueled largely by the low rates. Nice silver lining to this pandemic is that we've seen all-time lows and we continue to see that. At the moment, we're seeing the bank prime at 2.45 and holding steady. Bank of Canada is the one who dictates the prime rate, and they had a release earlier in November that just flat out told us they don't have any plans to raise rates until 2023 in the wake of this pandemic. So we have very low rates right now, and we can expect that to stay for some time. We're seeing, what does that translate to for the consumer? We're seeing variable rates as low as 1.7 to 1.75, that kind of range. Fixed rates in the 1.89% range. So yeah, it's a great time to be borrowing for sure. A lot of people have been inquiring lately about breaking their existing term. So that's an important question for those that are already in a mortgage and wondering, can I benefit from the savings and the rates that are out there now? The answer is maybe. And I would definitely suggest reaching out to a mortgage professional such as myself. It does not take much. We only need a little bit of information such as an existing balance, current rate and term remaining, and the penalty. And really a fast calculation, we can figure out if it makes sense to either break the term, pay the penalty, and you'll save a bunch of money and make it up. Or there's also some blend and extend options. If that doesn't make sense, there's some blend and extend options that involve no penalty and a lower rate. So bottom line, there's definitely some potential savings out there, and it doesn't take a lot of time to figure out if we should be adjusting things for you. So good time to reach out to a mortgage professional about that.
Yeah, yeah. Like, I'm gonna put you on the spot over here with a couple questions. Like, I guess, when does for a person who's just coming into a mortgage, when does it make sense off the recommendation to say, hey, should I go variable or should I go fixed? You get pre-approved for both, but when it comes time, I got an accepted offer on a townhouse, for example, and I got to go variable or fixed. What's the type of sentiment that you see a lot of people doing, and for what reasons?
It's a great question, and you're bang on when you say that we're going to hold both. So when you come and get a pre-approval, we're typically going to hold a few options for you, but with a few different banks, because we at that point we want people to focus on the buying process and whether or not that property is right for them. At a later stage, we can sit down and compare all the rates and figure out the best fit. I see a lot of people taking variable. I think that I think personally that's a great option. And listening to the Bank of Canada say they have no plans to raise it for some time makes it even more attractive. That said, it's a risk tolerance thing. So some people may not be comfortable with it. We all have to sleep at night. We've got enough stress as it is. So we want to work with people to make sure that they're comfortable with the risk. But if they are, variable is definitely what we would recommend and what we're seeing a lot of people do these days.
Is it possible to do a blend, like a half and half variable, half fixed? Is that even
It
still possible?
It absolutely is. Yes, indeed. Not every bank's going to offer that, but there are some banks that do offer sophisticated solutions and like that, and we can split the mortgage up. We can go half variable or half 70-30 fixed variable, whatever blend we need to do to meet the risk tolerance, it's definitely an option.
That's perfect. And like you said, not every bank does it, and I'm also sure not everybody qualifies for it. So I think talking with someone like yourself might be the way to go to see if that is an option. And regarding, breaking existing mortgage, can you just give me a bit of an example of like a classic example where it makes sense for somebody to break one?
Yeah, sure thing. I mean, it really depends on things like term left and what the penalty is. That the penalty is generally dictated a lot by what your rate is and what the term remaining is. The banks these days will charge you a penalty that's what they call interest rate differential. So they're basically taking the your rate versus current rates and charging the differential between the two on your balance remaining. So in theory, that they do that because they want to avoid us doing exactly this and breaking rates and going to a lower rate. Because if they're letting the money out at 3%, they don't want to get it back and be letting it out at 1.8. So the penalties are designed to wipe out savings, but that said, there's a lot more to the calculation than that, and there's a lot of spots where people have just the right amount of time left where the penalty is not that bad. And an example, we just did one last week where the penalty was about 4,000, but over the remaining 2.5 years, the client's going to save almost $16,000.
Got it.
So
Got it.
and have a new 5-year term, which extends their maturity an extra 2.5 years. So that could potentially play in and be a savings for them too if rates did go up. So that's kind of scenario we're looking at. Sometimes it doesn't always make sense, in which case we'll stand pat and just keep an eye on it for them. But lots of times it does make sense, and we can make a move to save them some money.
No, that's great. So, quick advice would be to connect if someone's even thinking about either pre-approving, connect if someone's thinking about breaking their mortgage because it's a COVID environment. I'm assuming everything you're doing is over Zoom and you don't even have to meet with the people. And I've been working with Dara for a while over here. I think he's a solid person to get really, really good information from. I don't think he's gonna. There's no charge for a phone call, no charge to do some analysis over here. So for those of you listening, if you are, in that realm of thinking of either breaking a mortgage to see if there's a savings or pre-qualifying for one, it might be a fantastic time because in my lifetime, I don't think I've ever seen rates this low before. And which means there's really only one way they're going to go, and that's the chance of them going up as compared to further down. It's much higher. In the next 5 years, rates going to go up or down. Well, down would be insane. And if they did, how far down could they possibly go? So for those of you listening, by all means, connect if you are in this idea of thinking about it, just because it could be a great savings. But thanks very much, Dara. So I'm going to shift gears over here to Ryan, front lines of the real estate market in Vancouver and the Lower Mainland. Ryan, let's start. Anywhere you want to start, tell me what is going on in Vancouver.
Sure. Good morning, guys. Yeah, it's still quite busy out there. I mean, the 13 plus years I've been doing this has been our busiest year. Spring was obviously slower for everyone. And then sort of around midsummer, it started to pick up quite a bit. So even if some of the stats were up 29% from 2019 October, which is pretty crazy, usually start to slow down a little bit by now. And the price is interesting is the detached market is leading the way. So it's up 8.5%. Townhouses are behind that and they're up 4.4% right now. And condos are up 1.1%. So kind of what's happening is that people are making a shift that they need more space because they're going to be working from home for the foreseeable future. So a lot of clients are moving farther out to Fraser Valley or, Coquitlam, away from the city. And with that, the detached market is actually the busier aspect. So detached market and townhouses are quite busy. Condos are trailing because just less space. And then there's some concerns with the insurance issues with the condos as well. And then, so buyers versus sellers. So I would say it's probably still a seller's market for the most part, depending on the product. But if you're selling a detached house right now or a townhouse, then it probably is a seller's market. Most stuff is selling within a couple of weeks in the detached market and the townhouse market right now. So Yeah, and then as far as like asking versus discounts, most of the stuff for the townhouse market and detached houses is actually going for multiple offers. We just did one in New West a few days ago. It was listed at just under 1.1 and it ended up going 60,000 over with 8 offers. So especially that kind of entry level point, which I would say is up to 1.2 million for an older house or a townhouse. A lot of these ones are going to have multiple offers. So that there's not really a lot of discounts, unfortunately. If people are looking for sort of a deal, some of the condo market, you could get some deals because some of the insurance issues where you're seeing really high deductibles right now because there's been a lot of claims in some of these buildings. So condos, for example, in Langley, some of the ones that are maybe 5 to 10 years old, there's a lot of inventory out there. So you could get a discount on a condo right now, but still a good investment because the SkyTrain is going to come out there. So we have been saying to investors to look out that way. And if you're looking for a bit of a deal, a condo might be the way to go. So hot areas of interest, like I think the Fraser Valley in general is kind of be the biggest leader for prices because that's where people are moving to. And then places like Langley that's going to have the new SkyTrain and more infrastructure, I think is going to have one of the bigger increases. So Willoughby Heights, for example, is an area that we're sending a lot of buyers to because there's a lot of new development happening there, and then SkyTrain is going to be close by. And then yeah, upgrading. So a lot of people are upgrading right now. So we're seeing a lot of scenarios where people are renting, like they're renting downtown and they're paying, $3,500 a month for rent, and then they no longer have to go to their office downtown. So those people, or if they own something like a small condo and you can work from home, we're seeing a lot of people moving farther out, like Ladner, Fraser Valley, where you can get a house for similar price for what you're paying for your condo. So it does probably make sense on a case by case basis. If you're in a job where it's unlikely that you're going to go back to your, downtown office, and that was kind of your hub before, and now you can work from home. It may make sense to buy more space, especially land. And if you can afford it farther out and make that work for your lifestyle, I think it's a good time, especially with what Dara said with the rates being so low. Then it's a good time for that.
No, that's great. Tell me, so I'm going to put you on the spot here a little bit, Ryan, with some questions. Tell me, from what you're seeing for what buyers are offering,
Mhm.
is it like over asking? Is it 10% discount, 5% discount? Like if somebody was actually buying like condos versus townhomes versus houses and areas as well, what are you seeing? Oh, is there a discount right now?
Yeah, so there's not really much of a discount on the townhouses and houses. So the townhouse deals and the detached house deals that we've done these last 4 months, anyways, have all been over asking. So the one that I just did the other day, New West, went 62,000 over with 8 offers. And the townhouse ones that we've done, they've either gone a little bit over asking or like rare cases under, but most cases are over asking as well. So I would say, to be honest, for houses and townhouses, you could look to go 5% over with a lot of the product. The condos is where you're going to see a little bit of a deal. We just sold one in Vancouver. The buyer got about 15,000 off for an older condo, and I think because there's a lot of inventory with condos, you can get make up to 5% in some cases, just because there's a lot of inventory. But townhouses and detached houses, I think most cases I would say you're going to pay asking or over.
Asking or over, yeah.
Yeah.
I was hearing that some neighborhoods at certain price points are really, really hot. I live in North Vancouver, and I heard houses under 2 million, which aren't many, but kind of that hovering around there, hot as hell, apparently. And are you seeing that as well, where don't even think of asking for a discount type of thing?
Yeah, most cases. And most of the buyers that we deal with are kind of entry level buyers. So they're actually looking up to the sort of between 1.2 and 1.4, which is not North Van, but, like New West, Tri Cities, Coquitlam, that kind of stuff. So yeah, it's very competitive because you're competing with similar situations and similar people. So yeah, I mean, the more expensive markets, like I live in Vancouver and North Vancouver, they're still selling, asking or over just because there's not that much inventory as well.
Yeah, yeah.
So
And
that's
uh, and a quick question to finish off here. Is the reason why a lot of condos are a good deal right now is because of the strata insurance?
Yeah, I think there's two things there. So the strata insurance is one. So what's happening there is there used to be about 30 insurance companies that would insure the stratas. Now I think there's 12 or 13. And the reason is there's been a huge increase in claims into the strata buildings as far as like leaks and levies. So a lot of the insurance companies lost the appetite to insure these stratas. So that's one reason it's gone up. And then because of the claims. So we've seen buildings just recently, one in Metrotown, where the water deductible was close to $1 million. So that means if there's any claim in the building that's below $1 million, which it should be, the strata would have to pay out of pocket. So you have to be quite careful there because you can bankrupt your strata. So that's one reason. And the other side of it, which is I think is probably the bigger reason overall, is people just want more space because they're going to be at home more. So if you're working at home with your partner and you're in a small, one bedroom, it can get pretty difficult. So I think a lot of people are now saying, yeah, we're going to be at home for the foreseeable future. Let's sell our place and get more space. We're probably going to have to move farther out, but it still makes more sense.
Yeah, no, no, that's great. And I guess again, if anyone was thinking of upgrading or thinking of getting into the market, usually you want to work with someone who is kind of dialed in. If you're not working with anyone right now, highly recommend Ryan just because he's always given me great information. One of the condos that, as an investment property that Ryan and what Ryan helped me with. It's in that similar scenario where we just had the debate whether to do a special levy
Mhm.
to pay for the insurance cost or whether to increase the strata. Almost
Right.
unanimously, everyone said, let's just pay the special levy because we didn't want the property value to go down by people coming in and seeing this outrageous strata fee because we were also concerned about our property values. But that is the type of thing that you want a good realtor to help to guide you as to the buildings that are doing these types of things that are preserving their value so you're not blindsided when you step in all of a sudden you're hit with this special levy. So that's really great information there.
Thanks. Yeah, I think that's a good point. So I think right now the main thing is, yeah, if you're buying a strata at a condo, which obviously a lot of people still are, we have to be even more cautious now about how the insurance deductibles and what's happening with the building as far as repairs and what's in their reserve fund, that kind of stuff. Because yeah, you're right. You could get hit with all buildings are going to increase their deductible every year, but yeah, you don't want to get stuck in one that has like that, close to $1 million deductible. That's going to be a huge issue for resale.
Yeah, absolutely. All right, so I'm going to switch gears a little bit over here, Ryan. Joel and I are going to do a stock market update, which is a very, very hot topic right now, and then we'll see if there's any questions at the end. So, Joel, are you there?
Yeah.
Okay, so a quick little update as to where the U.S. market cap over GDP is. Earlier in the year we were as high, like a 100% is kind of where everyone, the stock market is correctly valued. And if you'll see by the numbers over here, when COVID hit, we went down as low as 106, but then we slowly been climbing back up. Now we are, it kind of peaked in late August, but now we're at about 179.9. Really, it's the future outlook that we're trying to get a handle on. So what Joel and I have done is we've taken a look at different sectors and also what's happened in the market recently, and we're going to sort of share what the experts are saying. So a couple of things to highlight over here. The markets have made exceptional gains. They basically captured back most of the losses that they made back in when COVID hit in March. And for those of you who are clients who have been listening to our webinars, we were saying that there's some serious values out there. We should be putting more money in. And many of our clients took our advice, with our help. And we've seen all double-digit gains since that time over here. So a couple of big things to note. The U.S. election, the outcome was one of the top things in the story, which affected the stock market. And of course, that now we have 2, potentially 3 vaccines that are on the table now. The markets have all reacted quite positively to this. So the big rebound winners, you can pretty much throw a dart and hit one. In other words, pretty much every sector, except for possibly energy, was up significantly. In energy, less people are on the roads, less airplanes are flying. So energy sector, it hasn't quite made its rebound, but almost consumer staples, financials, all of these other sectors have really, really done quite well over here. Does that mean there's still more money? There's still an upside? Absolutely. Absolutely. There's still an upside, but now it's trickier. Before it was easier because the markets were all down. Now we're at back to levels. So now looking for value, I think, is the next play over here coming into 2021 over here. Because there's a split government over here, Republicans taking the Senate, and of course, the Democrats winning the election. That's actually historically very, very good for the markets. So 2021 is looking good, except where you put it will be the trickier part over there. Okay. So what we like to do is we like to dissect a couple of different stocks. We're not big on recommending stocks to clients, but what we do like to do is like to do the analysis, especially for those people who kind of, are looking to focus on a couple of different areas. So right now, one of our big focuses, because we're in a sort of a Good Friday, Cyber Monday, Thanksgiving, American Thanksgiving, as well as coming into the Christmas season. We wanted to actually focus a little bit on retail, just because we feel that there are certain companies that we feel are going to do quite well in retail. We'll start with Lululemon over here. Analysts put them at a 2.1. Anything under a 2.5 is sort of a buy signal. Joel, did you want to comment on over here?
Yeah, retail's been doing really well, and we're seeing people have a lot more disposable income because they're not traveling. So this space should pick up really well. And looking into people, Christmas and everything, really interested to see what the actual numbers are.
It's a strong company that even though they've gone up quite significantly, this is one of the areas, especially with the online presence, that we think is going to do quite well over here. This is actually my favorite one right now, and this is Alibaba. Alibaba, for those people who are unfamiliar, this is essentially the Chinese Amazon, and China has four times the market that the U.S. does. And I think, so full disclosure, this actually is a company that I am invested in. But one of the things I really like about them is because of Trump not being in power going forward, I do believe that the relations with China are going to get much better. That's basically what the market predictions are. Alibaba is one of the companies that is very, very well run. And I guess I feel it's kind of one of the last ones that are now on sale. Like we said, we've had a lot of market gains. So if you notice the analyst rating at 1.6 over here, Ray Dalio, who is, largest hedge fund manager in the world, has just taken a very large position in Alibaba. So now, is there risk? Of course, like with anything, there's a risk. There was an IPO that they were waiting on, which didn't go through. With communist government, there's always a chance of more regulations. But right now, from a lot of analytical points, including my own, I do feel that this is going to do quite well. So I have taken a position in it. Walmart is probably my second best pick. If you take a look at the analyst rating at 1.9, again, Ray Dalio took a large position in Walmart, which is one of the reasons why I'm also liking it. I also sort of find that they've got a very good business model, and moving forward, they're getting into a lot of other sectors. You go into a Walmart now, and of course, you could buy your groceries there. You could buy your pharmaceuticals there. You could also go shopping over there. They are such a large player. They're not going anywhere. With COVID, they've got a very, very good strategy. And if COVID, finishes, you're hearing a lot about unemployment. You're hearing a lot about jobless claims. Well, guess what? Those people will be shopping. They're not going to be in the high-end stores. They're going to be attracted even more to Walmart. Joel, did you want to chime in at all on either of those?
Yeah, so from a Morningstar standpoint, you can see it is quite a bit overvalued that they feel. But looking at the PE ratios, a forward PE of 26, that's about a 4% rate of return that you'd be expecting, investing long-term at this price, which historically isn't, a huge rate of return. But when we compare that to interest rates, it actually looks very attractive. So it's important to always look at, what are your alternatives for really safe investments. And Walmart, of course, is a really safe investment because the people, shopping at Walmart, they need to shop at Walmart, and that's not going anywhere.
Yeah, and that's how I sort of feel. If you're shopping at Walmart and you need to buy things, it doesn't matter whether you have a job or not. You just might not be buying as much, but you're going to keep going there. The other one is Target. I guess this is kind of along the same vein over here. Lot of analysis on Target, also expecting to do quite well, especially in the short term going into shopping season. I think budgets are a little bit tighter over here. People are going to be looking for value. And I think that the market is just so big that a lot of people will be attracted to these types of retailers over here. Ideas on Target, Joel?
Yeah, exactly. A very similar idea as Walmart, that people have to shop at Target. It's got a big base of loyal customers like Walmart does, and so even if you're accepting like a 4 or 5% rate of return on the cash flow that they're generating, that's pretty good considering how low the risk is and what you can get in the bond markets or other low risk markets.
Yeah, and I think to like, we could talk about stocks all day, but we also like to we have a lot of index funds and ETF investors out there. One that seems to be having predictions to do quite well is a China ETF. And the only reason is because, again, because the US government over here, trade relations, of course, is expected to be much better with a Biden government. So China ETF is showing, quite a bit of strength. If you take a look at, this ETF, Alibaba is one of their top holdings over here, as well as, many other Chinese strong companies. This over here, if someone was looking for emerging markets, so the U.S. actually is projected to do quite well in 2021 as a market itself. Emerging markets are expected to do a little bit better, and of the emerging markets, Latin America, China are both sort of the two front names, with China probably leading the way for emerging markets. So here's an ETF for somebody to investigate. Again, we're not recommending the buying or not buying of any of these. What we're doing is we are educating our clients and pushing them in the right direction for those who do like to invest on their own. For those who basically need help and they want to get professionals involved, of course, this is, of course, one of the services that we do. So if anybody is wanting to essentially relook at their portfolio, make some changes, or have a discussion, we, of course, open it to connecting with us. And so we'll slowly finish it off over here. Quick gratitude to all the frontline workers, but it's all of our jobs to follow the rules, and then that's how we're going to flatten this curve over here. So if there are any questions, feel free to pop them into a chat or to connect with us directly. The next session for our clients is going to be December the 19th, which is a Saturday. One thing to remind people of is that we are actually this is a client monthly update over here, and so it's being sent directly to our clients. So no offense if anybody does not receive this, even though they are registering. But what we want you to do, of course, we want you to become a client. So feel free to connect with us, and we can show you how we're able to help you. All of our strategies is, I think, the greatest value that we bring. And then, of course, connecting with Ryan or Dara if you are interested in the real estate. So we can sign up on our Latitude West workshops monthly calendar website. So we'll end off over here, landing on the ready to connect. Here's the information. You might want to take a screenshot. If you want to connect with myself, assistant@latitude-west.ca. If you wanted to connect with Dara at Citywide Mortgages, Dara at citywidemortgage.ca. And if you wanted to connect with Ryan at Stonehouse Realty, at ryan@rwrealestate.ca. So we're going to end the recording over there. And if there is anyone with any questions, then they can feel free to ask. Otherwise, we will see you guys on the next client update.